Hey everyone, it is Evan here from the Trade Risk on Tuesday, March 10th, here with a midweek market recap video. We're going to cover all of the major markets and the current market environment. So volatility remains elevated. We're still on this roller coaster, seeing historic moves continuing last week with the credit markets. This week we have circuit breakers triggering on yesterday's open. We saw a VIX at 60 briefly, and we had oil dropping 25%. I mean, these are huge moves, lots of dislocation. So let's get into it here. First, covering what's going on with our market technicals dashboard. You can see we had a strong rebound today. Dow closing up 5% right alongside the S&P 500. IWM a little bit weaker, and the Q's up 5% as well. But notice even those strong moves for one-day percentage returns still keep us firmly in the negative here over the past 5 trading sessions. All of the major indices are below the key simple moving averages, except for the Qs, again, still trying to hold on to that 200 period simple moving average. Now, if we scroll down and take a look at sector performance, you can see the defensive tone to the market is clearly at shape here. We got healthcare, staples, and utilities at the top of the relative strength list. And on the downside, we see energy really getting crushed here, followed by financials and Dow transports. And on in terms of major markets, it's all volatility again. So the VIX at the top of the list, followed by natural gas, which is pretty interesting. We'll talk about, and TLT, which is the long bond. And on the downside, oil, emerging markets, and the S&P 500. So let's jump into the charts here with the S&P 500 weekly time frame. We always like to start with the weekly chart just to get a picture of what's going on in the broader sense, clean up some of that day-to-day noise. And you can see here for the S&P 500, we are at the top of this week's range. Now, of course, it is only Tuesday, so this candle is going to look different come Friday. But at the lows here, we had, approximately a 8% downward price discovery here this week. So we got as low as 27.34. With today's aggressive rebound, we're back to the top of that range. If we zoom out here, you can see we're coming into some prior structure. And if we throw on this view here, so this is the view that we've been looking at and we looked at and mapped out on last week's market recap video. We came down to this 2746 zone, and this is an important zone because in my opinion here, this is going to be a good spot for the market to try and hang on to, because it does seem to me that there's a slippery slope, kind of an air pocket that I would consider below this zone, just because there hasn't been a whole lot of previous supply until you get down and pivots until you get down around 2600 in the S&P 500. So the lows from this week, I think, are pretty important here to hang on to. If we start closing below them, I think we have an easy, quick 5% down to about that 2600 level. That could happen, frankly, with a VIX at 50 or 60, basically happen in one session. So I do think this is an important area to try and hold on to. This brings us is to where we traded down to yesterday, just shy of 20% off of the all-time highs made incredibly just 13 sessions ago. So we've essentially corrected 20% in 13 trading sessions. Very remarkable unwind here, and the speed at which we have probed lower. We are certainly, of course, oversold on basically any metric you could throw, any oscillator you want to use. You could see that we're very stretched in the short term from normal distribution, normal types of levels. So a snapback here, some type of rebound, some type of pause or stabilization makes a whole lot of sense. But of course, we have to remember that we are in a very unique environment here. Really, there's no prior script to this because we're in some uncharted territory in a lot of respects. But basically, with a VIX at, let's see where we ended up closing on the session, with a VIX at 48 and circuit breakers firing off in 3 to 4 to 5% daily S&P 500 moves. I mean, this is pure sort of price discovery for the market. It's trying to figure out what fair value is, what the implications are of all of the headlines, all of the risks out there between coronavirus and what the Fed is trying to do, pricing in oil, the impact there, and the market is essentially going to be swinging back and forth, mostly driven on headline fear and emotion, and essentially trying to just determine what makes sense here based on corporate earnings and all of the risks that we're dealing with right now. And I don't think there's going to be a very near-term definitive answer to any of these questions. Of course, elections throw in there too as well. So basically what this should leave us with, and again, I don't want to get into the actual fundamental drivers of this. That is not my expertise here, so I'm not going to even pretend to try and make sense of that or put some type of number on it. But I think the point here is that I don't think we're going to have definitive answers to any of those things in the near term, and I suspect we're going to see volatility remain elevated. I would expect at some point we're going to be back below 50 and 40, but even a VIX up into the 30s, where we would probably, it seems likely we're going to be hanging out in for at least the near-term future, unless something really drastically changes. It seems like we're still going to be in store for these large swings, these large daily moves in both directions. Even a 5% S&P 500 move like we're looking at right here really doesn't change the big picture here, doesn't change really anything. I mean, it gives us a little bit more confidence on this 2700 as potentially being a floor, but still absolutely not out of the woods. We could in fact rally all the way up into the 3000s, which would be again another 5 or 6%, and we would essentially still be in a downtrend, in a high volatility period, in a risky environment. So kind of the same things we talked about in last week's video. You have to protect yourself, of course, above all else. If this is not a market environment, if you don't like volatility, if that's not conducive to your trading strategy, then the best course of action is to step aside and basically do nothing. If you're someone who thrives on volatility, if you like the big daily ranges, perhaps now this is the time where day trading makes more sense. You get a ton more move throughout the trading session. Then this market environment might be for you, but you just, of course, have to understand the risks and overnight risks specifically that are associated with this type of market environment. So all in all, I think that's kind of the levels. I mean, these are the levels I'd be looking at here on the upside, basically going up to, all the way up to 3,000 or so. I mean, if this low is good here for the next couple of days, again, I wouldn't be surprised to see a move all the way up to the 3,000s, not a prediction, but it wouldn't be surprising to kind of get back up there, fill some gaps, repair some damage, work off oversold conditions, and then the market will continue to kind of slog it out and basically, again, work on price discovery, figuring out how to price in all of the events that are unfolding. So from here, probably a wide sideways kind of sloppy range, maybe like a 2011. That's certainly what comes to mind for me in this type of environment here. I don't know if we can get back. We can get back on like a weekly time frame here, but something like this here could be a script that we see. Not sure that it is going to be, how it unfolds, but again, I wouldn't be surprised to see large weekly moves for the next month or so, and as this market sort of digests. So that's the action there. Again, approximately just under 20%. So I guess, if you're using the classic definition, we are not in a bear market yet, at least not in the S&P 500. If you want to look at bear markets, I guess we go to the IWM, the Russell 2000, which sold off 23.5% here from its highs made just earlier this year. That was the lows down at the bottom of this week. If we go down to a daily chart, actually it was the lows today. We did go negative, I forgot here, in the Russell 2000. So we did make new lows today. Actually not sure if this number is updated then, but regardless, quite a significant drop, underperformance here in small caps, coming all the way back to nearly the 2018 lows here that we made just over a year ago. So almost all the way back there. But again, you can just see how stretched we are, how fast we just cannonballed into the pool here and just sunk to the bottom for the IWM. So naturally, again, some mean reversion, some snapback stabilization does make sense. But again, it doesn't necessarily get us out of the woods here over the short term. So Russell 2000 suffering the biggest drop, has a big gap in here, very stretched, and again, extremely volatile. Last but not least is the Nasdaq 100. Nasdaq 100 here, about 19% at the lows yesterday. It is still holding on to its 200 period simple moving average. Again, structurally here, this definitely looks the best. If we go to a weekly chart, in fact, certainly an aggressive exit, right? An aggressive fall, an aggressive break of this trend that we were in for a couple of months. But if you really look at the price action here and the where it came and retested, we essentially came right back, undercut just briefly, but came into this 190 zone, which was the big breakout area back in late 2019. So you could arguably say that we just had a long-term sort of breakout retest here, and the market so far is responding favorably, and buyers are stepping in at this prior area. So the Qs from a technical perspective still look the best. Again, I think just like the S&P 500, if we start losing the lows here from Monday, I think this has a swift move again all the way back down to 7-8% drop in pretty quick order down into the 180 or sub 180s. So I do think we have some good lines in the sand to use going forward for the Nasdaq 100, and if this bounce continues, then into the 215s or so, essentially last week's highs, that's basically where we could see this. We would expect this market to sort of run to. So that's the market environment. Again, be careful out there among all else, and just recognize the type of risks in this environment, particularly when you start getting exchanges that are hitting circuit breakers. Then you have to worry about your brokers being open in regular order fashion to actually get orders through. Thinking of Robinhood, of course, but there are other examples out there where even if you wanted to place a trade, even if you wanted to get out of a position, you may not be able to. And again, those are the risks that aren't easily observed or talked about, or just thought of as active traders, and we need to really be aware of what this type of environment poses. So that's the market overall. Let's get into some other markets here. We'll go to bonds, which we charted a bunch of times and talked about this just epic move that this has had to the upside here. We've looked at rates, we've looked at the long bond funds like TLT here. You can look at just the 10-year if you want to look at AGG, and all of these moves got basically parabolic here in the past couple of days as there's been a total flight to safety. Essentially get out of equities, go into fixed income, preserve that cash. That's essentially the trade that has been on here. But of course, we noticed yesterday that as equity markets were melting, we didn't actually see, we saw the high prices of the day for these bond funds, and then we proceeded to sell off throughout the session. So basically we're seeing kind of a hand-in-hand sell-off there with bonds, bond funds, and equity markets yesterday, and we got the follow through to the downside today. Again, I think just this makes sense from a classic structurals perspective here on how stretched these markets got. I wouldn't be surprised to see AGG trade down to the 115s, at least get back to this longer term trend line. Same thing with TLT. I mean, just getting back to this slope here, which is still extremely steep, but coming back down for TLT, another 3% to the downside, should not be that surprising whatsoever in the short term, and we'd still very much be in an uptrend. This does look like it could potentially be the big blow off top there, but we still don't know yet. We still have plenty of long-term trends that are still in the favor to the upside here. We still have good momentum kind of carrying to the upside, so it's be cautious calling the end here, I would say, for bonds, but I think we're just due for some pausing and retracement, and that's exactly what we're seeing here. Equity markets retrace to the upside, bonds come down to the downside a little bit. and then we'll kind of figure things out from there. Seems like the path here in the short term. If we go to metals next, we'll go to gold. Not really doing a whole lot this week. Basically, still just in a strong uptrend, still doing a great job at providing safety and kind of risk off. It's not, marching higher, so to speak. It is coming off of the highs here again, so maybe a little bit frothy, but still just in a nice uptrend there. Silver, again, just less exciting here as a risky, as a risk off type of play, but still, kind of hanging in there on a relative basis, I guess, versus equities. Still, though, long term, just kind of trying to hold on to this bottom end of support. Last but not least, and the big story, of course, this week was energy. USO putting in a floor, rebounding 11% today, which is a big rebound. But of course, when we look at what happened yesterday, we fell 25% in the USO ETF. I think this is down. I charted it looking at futures earlier. I think this is down 50%, 60% just this year. So we're talking about oil here down in 2.5 months, or I guess 3 months, down 60%. So and just the speed at which it's unwound here is just incredible. Of course, doing a lot of hurt for the energy sector specifically. Surely going to close down a lot of companies, frankly, at prices like this. We'll see if they stay down here. We'll see how this obviously develops, but historic moves here for USO. But what's interesting is natural gas, and I think this might be the tell here. Again, it's been uniquely difficult to try and call any type of bottom for natural gas, but you're seeing a good amount of volume come in. You're seeing the stabilization here, I do think that now that we're back up into this 14 range, and particularly if we can get back over 15 or so, maybe you finally see some type of intermediate term bottom here for natural gas. Pay attention to that. I think it's interesting here. It's not, not something I have a position in or not that interested in. Just don't have any trading systems on this particular commodity. But I do think just from a TA perspective here, I think natural gas looks like it could be finally starting to put in that bottom. So that's it. I think that's the action this week. Lots going on, and I think we're still in the middle of kind of the storm here, but hopefully everybody survived here so far. Again, 20% correction in about 13 sessions for the S&P 500. Pretty remarkable. Again, as long as that VIX stays over over 35, I think you have to be careful, and we're well above that right now. So that's it for me. Thanks so much, as always, for tuning in. You can subscribe to our YouTube channel or follow us at The Trade Risk. Have a great rest of your day. We'll see you back here for some swing trade ideas tomorrow morning.